Ladies and gentlemen, good day and welcome to the Q2 FY26 earnings conference call of Borosil Renewables Limited, hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manan Mehta from Axis Capital. Thank you, and over to you, Mr. Mehta.
Thank you. Good evening. On behalf of Axis Capital, I'm pleased to welcome you all to the Q2 FY26 earnings conference call of Borosil Renewables Limited. We have with us the management represented by Mr. P.K. Kharuka, Executive Chairman, Mr. Ashok Jain, Non-Executive Director, Mr. Sunil Rohta, Whole-Time Director and Chief Financial Officer, Mr. Balesh Talapati, VP Investor Relations. We will begin with the opening remarks from the management, followed by an interactive Q&A session. Thank you, and over to you, sir.
Thank you very much. Good afternoon and welcome to the Borosil Renewables Q2 Financial Year 26 investor call. The standalone and consolidated financial results for the quarter ended 30th September were approved by the Board of Borosil Renewables on Tuesday, 11th November. Our results and an updated presentation have been sent to the stock exchanges and have also been uploaded on the company's website. We will now discuss the operations of the company on a standalone basis as well as on a consolidated basis. The company received 371.49 crores from investors towards preferential issue of shares, and the board approved allotment of 69,43,691 equity shares to the respective investors on 17th October 2025. In respect of issue of warrants made earlier in February this year, the last date for payments by allottees is August 2026. However, some have fully paid up already, and a sum of rupees 282.52 crores remains to be received by the company from investors. Interfloat Corporation, a step-down subsidiary of the company, has faced significant challenges in retaining customers following the cessation of annealed glass production at GmbH, Germany, from 31st December 2024. Fierce competition compelled Interfloat customers to seek highly reduced prices for solar glass, which were unremunerative for Interfloat. This has left Interfloat with a highly reduced demand, which is insufficient to pay for its fixed operational costs. Following an independent review by the management of Interfloat, it is assessed that there are no clear indicators of demand recovery in the near term that would support a return to profitable operations. In view of this, the management of Lakshman AG, which is the company's wholly owned subsidiary, has partially provided its exposure in Interfloat during the quarter ended 30th September 2025, and accordingly rupees 33.87 crores have been considered as impaired out of the total exposure of rupees 57.59 crores and has been provided for in the books of account of the company and disclosed as an exceptional item in the above results. Coming now to the standalone performance, the company achieved sales of 378.44 crores versus rupees 332.26 crores in the trailing quarter and rupees 265.61 crores in the same quarter last year. The company registered EBITDA of 33.2%, showing a significant improvement over the 19.9% in the corresponding quarter. The absolute amount of EBITDA at rupees 125.5 crores shows a quantum jump of 137% from rupees 52.88 crores, 19.9% of sales, in the corresponding quarter, and 36% compared to an EBITDA of 92.53 crores, which was representing then 27.8% of sales in the preceding quarter. Sales rose by 42% during this period compared to the corresponding quarter, and the major increase, which is 29% in sales value, came from the selling prices as the average ex-factory selling prices during the quarter increased to rupees 147.5 per millimeter as compared to rupees 115 per millimeter in the corresponding quarter, which was rupees 138.12 in the preceding quarter, leading to improvement in the margins. Besides this, the production efficiency is improved, which enabled a higher sales volume and better margins. Exports amounted to 45.61 crores, accounting for 12.1% of the turnover, compared to rupees 34.62 crores in the preceding quarter, when exports made up 10.4% of the turnover. The domestic demand continues to be robust. Manufacturing capacity for solar modules in the country has already reached 110 gigawatts and is expected to rise to 150 gigawatts by March 2027. We expect the solar installations in 25-26 to reach 35 gigawatts, which means modules or glass consumption of about 50 gigawatts, as against 25 gigawatts during the previous year. ALMM mechanism for modules implemented from April 2024 has led to increased demand for modules as well as for all the components including solar glass. Demand is expected to grow even higher. Present solar glass capacity in the country is 2,600 tons per day, which is to say 17 gigawatts. With the expected current demand of about 50 kilowatts for domestic, 50 gigawatts for domestic installations, imports occupy about 70% of the consumption, leaving huge scope for capacity addition for import substitution. Another 12 gigawatt of capacity, primarily for captive by a new producer, is getting commissioned by the end of financial year 26, and further capacity of another 16 gigawatts is to be commissioned by December 2026. Players, including 4 gigawatts by the company. The work on company's expansion plan project is in progress as per schedule. Finally, we see good prospects for the company over the next few years, looking at the growth in the sector, robust demand and stable selling prices of solar glass. This surge will come from both large-scale utility projects, PM Kusum scheme, and rapidly rising rooftop installations under the PM Surya Ghar Yojana. The company is confident to continue the improved performance in both sales and EBITDA in the coming quarters, barring any unforeseen circumstances. Now I come to the consolidated results for the quarter, which include the operations of the subsidiaries. The overseas subsidiaries, including the step-down subsidiaries, have generated net revenue of rupees 18.65 crores and negative EBITDA of 7.71 crores for the second quarter of the current financial year, as against net revenue of rupees 32.77 crores and negative EBITDA of rupees 24.43 crores in the preceding quarter. Provisions have been made for amounts due by Interfloat from GMB, 551,000 euros, and customer claims about euros 754,000. The results do not include any figures for GMP, which filed for insolvency on 4th July 2025. We understand that the plant of GMB remains shut and the insolvency. The consolidated net revenue for the quarter under review stands at rupees 378.88 crores and EBITDA of rupees 120.42 crores as compared to net revenue of rupees 346.58 crores and EBITDA of rupees 69.28 crores in the preceding quarter, which had the impact of losses of GMB operations. I'm happy to report that the company has been able to achieve a higher sales and much better EBITDA on the back of improved domestic operations despite shutdown of GMB, which was a drag on the profitability and performance. With that, I would now like to open the floor to questions that you may have.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congrats on good performance. My first question is with respect to the capacity utilization. What is the utilization you are experiencing right now?
Last month, the last quarter, we had pretty much full utilization of the capacity.
Oh, full utilization.
Out of 1,000 tons per day, it was more than 960 or 980 tons per day.
Okay. And was it similar to Q1?
Q1 was a little less. It was above 900 tons per day in Q1 as well.
Q1 was 942 and Q2 is 991.
So 942 tons per day in Q1, 992 tons in Q2.
Understood. That's helpful. And in terms of your realization for the quarter, you recorded 147.5. What is the run rate going in the current quarter, and how much more do you think you can stretch this realization to?
It seems to be about the same.
Okay. And lastly, on the other expenses side, they seem to have gone up a bit quarter-on-quarter. Anything to read into that 72 crores versus 62 crores?
So other expenses actually include some one-time expenses and some expenses which have been accounted in terms of the say support services and some payments made with regard to overseas subsidiaries because we were not able to pay directly from there. So some expenses have been paid to the auditors and all, and some consultation fees to lawyers overseas for this resolution and all, for restructuring of GMB or filing of the insolvency and all those things. So there have been some expenses which have increased other expenses.
How much would that be, and should that normalize into Q3?
Yes, we hope to normalize the expense. Some cut down will be there in those expenses.
Okay. And lastly, if you can talk a bit about what you're seeing in terms of new capacity coming in from competition or any pressures that you're seeing from the import side.
So as we have given the details of the capacities coming up, the total capacities after adding our capacity and the competition capacity will still be shorter than the demand in the country. So these capacities are now coming up because the anti-dumping has come into play and all. And since the demand is already at 50 gigawatt and capacities will not be more than 45 gigawatts in another 1.5 years time. So there will be still scope to add further capacity.
Okay. And anything more in terms of write-offs that you need to do for your European subsidiary?
No, there will not be any.
Okay. That's helpful. Thank you so much and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Akash Jain from Money Curves Analytics. Please go ahead.
Yeah, apologies for asking a very basic question. I just wanted to understand if I have to look at the glass per ton per megawatt, how should I think of it in terms of modules capacity in megawatt and how much glass goes into, solar glass goes into the module on a per megawatt basis?
I think about 6,000. How much is that?
See, about in the bifacial modules, about 46 kilo glass goes in one module, which is about, say, 580 watt peak or something. So from that, you can calculate the numbers, how many tons of glass will be required for a per gigawatt or say 100 gigawatt. 46 kilo per module of 518 watt peak.
Okay. And just one more quick question. On this interfloat, we have obviously taken an impairment, but at an ongoing level, will there be more losses over there because we have not stricken off, or that company at an ongoing basis will continue to make some losses?
There will be minor amount of losses which we are trying to curtail further. As you can see in the Q2, the losses have cut down sharply as compared to the Q1 in terms of the overseas subsidiaries, which also include certain provision because of the claims from the customers, past business which we have transacted. But going forward, that is not existing now. So the expenses will be much lower. So loss will be quite minimum.
And this company primarily only, in a way, buys or trades modules and sells it to customers. That is the primary, because there was also a manufacturing company in Germany. So what was this company primarily doing, sir?
So the manufacturing company has been shut, as you know, from 4th of July, it has gone to insolvency and all. This company has all along been selling the goods manufactured by the manufacturing company. And prior to that also it was importing and selling the goods into European Union. So this was a selling company or marketing company from that perspective. So it buys the goods or it acts on a commission basis and earns its income.
Now that we have closed the German company, do we not, what is the thought process behind continuing this and not shutting this down also? Because I would assume that that company typically will not do much business now, given that we have filed for bankruptcy of the German manufacturing companies. I'm just trying to understand is there a plan to completely shut this down also going forward? Can you also please tell a little bit in terms of that also?
You are right. That option also will come for discussion actually. We are trying to first see whether there are any improvement possible or not in terms of its profitability. And by next quarter also, we would have taken a decision regarding this. For this quarter, we will just try whether this can still be brought into positive position.
Oh, thank you so much.
Thank you. We'll take the next question from the line of Ronak Jain from Sanghi Family Office. Please go ahead.
Hello.
Hello.
Yeah.
Am I audible? Hello, am I audible?
Yeah, go ahead.
Sir, good evening, sir. I have one question that this EBITDA margins of 33% is it sustainable for future? What are your guidance on this?
I think we are fairly confident to sustain this margin at this level.
Okay. Sure, sir. Thank you.
Thank you.
Okay.
Thank you. We'll take the next question from the line of Rikin Shah from the Boring AMC. Please go ahead.
Hi team, great results. Just wanted to ask that across the ecosystem in solar modules, there's a lot of price correction that is happening, whereas we have a ADD which is lowering our price in dollar terms. So how is the end customer absorbing this in a time where perhaps his module prices are correcting?
So you have been seeing the results of the module manufacturing companies who are our customers, and their margins have been quite robust in that sense, and their ROC is quite robust. It's almost 60 to 80% in many cases, the return on capital employed. So obviously this is not a normal margin on a sustainable basis. So there may be some contraction in the margins for the module industry because of the overcapacity or whatever the challenges may be there. At our level, I think currently or so far we have not experienced any pushback from the customers with regard to the selling prices. So this anti-dumping duty in the form of MIP has been helping us a lot, and as of now we are not finding any reduction in or any kind of pushback in the price.
All right. Thank you. That's it from my side.
Thank you. The next question is from the line of Pratik Giri from Shubhlab Research. Please go ahead.
Hi, Mr. Sherpa.
Hi.
Good set of numbers. Mr. Sherpa, I just wanted to understand, the demand-supply dynamics at this point of time, because if I look at the industry demand versus the supply which we can do at this point of time, probably with 1,000 TPD capacity. So should we assume flattish performance every quarter from this point onwards? Because probably we are running at 100% capacity, or is there a scope of debottlenecking in the existing capacity? That's the question number one, Mr. Khelkar.
So to answer that question, I'd say that, you see, there is always a spur, so that you're spurred on to have higher attempts at better performance. So the higher demand for the glass is spurring us, the manufacturing team, to do even better, achieve better efficiencies, and we are trying for that, and hopefully we can expect some improvement, not very significant perhaps, but improvement nonetheless. In terms of quantities, we are already getting prices which are aligned with the MIP for the import prices, so I do not see much change there, and I would expect that we may expect a little improvement in the working efficiency going forward based on, constant effort made by the team, but generally in this ballpark.
Yeah, besides this, there will be, as is mentioned about efficiencies, there is also effort to reduce the cost in terms of the, say, power cost. We will be achieving some savings because our group captive power plant will get commissioned by end of this month, most likely. So we will have certain savings arising out of that, and also some operational improvements or some work which we have done in raw materials or coating materials will help us to achieve some efficiency. So there will be a certain amount of uptick in due to these efficiencies, and of course the production efficiencies will also be, our attempt will be to increase there as well.
Understood, Mr. Khelkar. So should we assume, just trying to, numerically understand it, debottlenecking should have a scope of only 5-10% is what you're saying. Immaterial.
I think 5-10% is reasonable.
Maybe 3%, something what we are targeting, about 3%.
Understood. Okay, got it. My second question is on, pardon my ignorance, Mr. Khelkar, but, I just wanted to understand the mix of our probably proprietary 2 mm glass, which only we have in the industry, if I'm not wrong. So the entire revenue is from that glass only, or there's another product mix here?
See, what has happened is, even though we were able to successfully manufacture fully tempered 2 mm glass, the Chinese could not do it. When the Chinese could not do it, and the Chinese control the market in the sense of overwhelmingly largest manufacturers in the world. So they are supplying something called heat strengthened glass, which is a safety glass, and you manufacture that by running it through the tempering line. But at the end of it, you don't get a fully tempered glass, you get a heat strengthened glass, which is a strong glass. It acts as a cover plate for the solar modules. So, in that sense, we still have not got anybody who is interested in a fully tempered 2 mm glass. If we find somebody, then of course we'll be very happy to sell them. And we are in discussions with some module makers to get them to try to buy this and make a product which is differentiated. So if they do that, then we will be having something better on our side. But as it stands, we are easily making all the 2 mm heat strengthened glass that we need to, and it's going quite well.
Understood. So the current revenue is primarily from non-2 mm glass, but the best which you can produce at this point of time.
No, we are making 2 mm heat strengthened glass.
See, the product is same as what is being available in the market. So 2 mm is almost 2/3 or 70% of our production, and rest is 3.2 millimeter. So 2 millimeter market is growing very rapidly, and we are very much there to supply 2 millimeter glass to the customers. It is significantly high portion of our sales now.
Understood. Mr. Jain, 2 millimeter glass has better realization than 3 millimeter glass. Is it right?
Realization is roughly the same. Maybe some difference, marginal.
Got it. Mr. Shekhar, may I put one last question, if you don't mind?
Go ahead.
Yeah. So I was just wondering that our CapEx, which we have already put a lot of effort for, is anyways going to come, at least next year, probably at least a year gap of 1 year. Is there a possibility of, acquiring any other small size glass manufacturer in the country so that we can, beef up our production, a little faster? Because ultimately this ADD is for 5 years. So I was just wondering, if you can, is there a scope of faster execution of capital expenditure or other capacity expansion?
To answer that question, actually, as of now, we are fully aware of all the manufacturers of glass, and we don't know that anybody is interested in selling. So
okay.
The question is a little bit rhetorical, but we cannot say anything at this stage. We have bought a number of companies in the past, successfully turned them around. So, if an opportunity presents itself, we would always consider such an opportunity.
Understood, Mr. Keshkar. Is there any Chinese inventory left into the ecosystem, or the module manufacturer has over-imported in anticipation of ADD, or is the inventory clear?
No, imports of glass from China are continuing every month. In very huge volumes they are paying. The module manufacturers are paying the duty and importing the glass.
Imported, yes.
So I would say that more than 70% of the modules which are today being made in the country are using imported glass. So despite the fact that we have been growing in the Indian industry, the demand has been growing even faster. So we do hope that with the new investments which have been made and which are under production, under construction and erection, we will be having a lot more glass in the country, and we would then be able to supply that requirement from within India rather than importing. But as of now, the demand is very robust.
I think from the module angle, there may be some kind of inventory built up which has happened, say towards the middle of September to now, because of two reasons. One was earlier because of the GST reduction implementation. Since the module duty was being reduced, the GST was being reduced, there were some holdback from the buyers. And of late, due to monsoon, there have been delays in terms of installation. So at the module level, there has been some build-up in the inventory. But typically what you have seen is that last 4 months of the financial year, that is December to March, the installations are very quick and very high. So we assume that some of these inventories will get cleared during these 4 months. And the module inventory at the module level will moderate to normal levels.
Understood. Those were my questions, Mr. Keshkar. Good set of numbers. Congratulations and good luck for future.
Thank you so much.
Thank you. We'll take the next question from the line of Daksh Malhotra from Ardrey Global. Please go ahead.
Yes, good afternoon, Mr. Keshkar, and congratulations on the good set of numbers, especially on achieving the margins that we had anticipated and even surpassing them. So well done. And if we happen to continue this pace of more than 30% on the EBITDA levels, it will definitely possibly to be better. So, sir, actually, I missed your point on the initial notes where you were mentioning that there is some other company which is planning to set up the solar glass manufacturing in India. To start with, they'll come with 12 gigawatt of production, and then there's an additional 15 gigawatt coming. So can you please repeat what you were saying then?
The 12 gigawatts is Reliance. They have Not that there's a formal announcement, but within industry circles, they have been saying that they should be in production by March of 26. All right. Though, again, industry circles feel this might be delayed till June. But at the end of the day, it's coming. Whether it's March or June, whenever it is, it's coming. So we expect that to definitely happen. And there are other companies which are coming up. Vishakha is coming up with 1,200 tons. Then Emerge is coming up with 300 tons. Avada is coming up with 1,200 tons. And there's another company in Hyderabad, I think. So they're hearing about.
They're not yet started.
Okay. So this Avada 1,200 tons and Emerge 300 and Vishakha 1,200, 700 from us, 600 from us. These are all, they are definitely coming. There's no question about that. And some other people have also been talking about it. And so we expect that production is certainly going to rise significantly. In fact, it'll more than double in the country.
So we are currently at about 16 gigawatts. Double would be with Reliance and all of the others, 1,200, 300, 1,200, and 600 of ours. Ballpark for about 15 gigawatt is already in plan in the pipeline, which will come.
I say 4,700 tons. 4,700 tons per day of melting capacity is getting added. If I'm right. Give me 1 second. It's
so actually, just to put the numbers on one page,
so can we please convert it in gigawatt? It would just be easier.
Yeah. So I'm just giving you that. 18 gigawatt is the capacity currently. Another 12 is coming from Reliance, and another 12 is coming from Vishakha and Borosil put together. So this is about, say, 48.
Vishakha itself is 1,200.
He's talking gigawatts.
Gigawatts, sorry, okay, yes.
So 18 plus 12 Reliance plus 12 of Borosil plus Vishakha, this makes it 48 gigawatts, which should happen by March 27. And other than that, Avada is 7 gigawatt, which
makes it 42 gigawatt.
Another 3 will come from Emerge, so 10 gigawatt from there. So it might become 55 to 58.
And the demand is 50.
Current demand is 50, which is also likely to go because the hydrogen demand has not yet come in this, because Reliance plant is basically for hydrogen, green hydrogen. They want to make the modules for use in power production for hydrogen.
But can you please correct me? Reliance was making that heterojunction technology, a different glass, right? Which was sort of said to be more efficient.
No, the glass remains the same.
It doesn't work in that.
No. There's no problem with the glass. There's no difference in the glass. The difference is in the module manufacturing machine and the cells, etc. So the glass remains unchanged. So there is some talk that they might be coming in with a top-on line also. The heterojunction is a little expensive. That's what we hear in the market. So we don't know what they'll do. So.
But in nutshell, sir, we see ample demand even after expanding our 600 ton capacity. We see ample
absolutely.
Demand, and demand should not be an issue for the country.
Absolutely correct. Yes. Absolutely correct.
Okay, we won't have to probably, look at export markets to fulfill our,
No. As of now, it doesn't look like that at all.
Okay. Thank you so much, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Deepak Purswani from Swan Investments. Please go ahead.
Yes. Good evening, sir, and congratulations for a very good set of numbers.
Thank you.
Sir, just wanted to check it out. What is our current average realization? Last quarter average was 147, and what is the current run rate which is happening in the market?
About the same.
Okay. And secondly, sir, if I were to look into the balance sheet, there is a significant improvement on the inventory side as well. So just wanted to get the perspective. How should we look into it going ahead? I mean, what are the key changes which has led to this improvement in the inventory?
Typically, when we close the quarter or the year, we have very little inventory. On the 31st March, we washed our warehouse with water. It was absolutely empty. There was not one single inch of glass in the warehouse on the 31st or on the 1st of April. So we try to achieve that. We have small quantities, very small quantities at the end of each month, but we have a habit of trying to clean out the warehouse completely. So we don't see inventories here.
Okay.
Generally. And of course, we've been trying to... Yes?
Yeah. Please continue, sir. You were mentioning.
Now, I'm just saying that so far as inventories of spares and raw materials, etc. are concerned, these are all, they depend on multitude of things. So right now we've got refractories for setting up, rebuilding our two furnaces, SG1 and SG2, which have been in operation since 2019. So we are ready with that. So obviously that inventory is showing up in the books. And once the furnaces are taken down for rebuilding, then those will get consumed at that time. So there's a little bit of surge and depletion like that.
Okay. And so just thinking a little longer term in nature, if I were to look into probably 3 to 5 years down the line, at the current juncture, from the industry point of view, there is a ADD component, and hence there is a sharp localization demand which is coming into the picture.
Yeah.
But if I were to look into 3-4 years down the line, if you can also give a sense, what is the difference in terms of cost of production for the Indian and Chinese players, and eventually at what scale we can reach, or probably will have a similar cost of production of the Chinese players?
I want to tell you,
perspective.
You raised a very interesting question to which I'll give you a straightforward answer. You see, the point is, how do you measure cost of production? If you measure cost of production in terms of rupees, then you have to value the input which you are using to manufacture a unit of output. Now, the value of your input might be higher here as compared to China. So it will appear to be a higher cost per unit of production. So that is a little difficult to fathom. So what we do for our internal benchmarking purpose, we try to see what are the units of consumption that we use per unit of output. So how many kilograms of raw material do we use, sand, soda ash, etc. How much fuel do we use to get a unit of output? And there we are better than China. We are more competitive than them. We are not less competitive than them. The thing is, they are subsidized in a very, very big way. And because of that subsidization, that they are selling at a lower price, it has nothing to do at all with any specialized lower cost of production or anything like that.
Okay, got it. And sir, finally, on the if you can also give share some perspective on the Interfloat Corporation. I think from the provisioning point of view, we have done 34 crore out of 58 crore.
Yeah.
Firstly, how should we see the remaining provisioning, and also is there any further scope? Is there any further subsidy where we have to take some write-off in the future, or this is only another entity where we are looking?
We are looking at what we believe we can derive from them, but they do have cash in their books and there's a certain amount due to us. So we believe that we should be able to get that money back. And that's why we haven't taken that write-off. And the write-off that we've taken is based on certain claims that certain customers had laid and which have to be payable according to European law for delay in supply or non-delivery and stuff like that. Because, you see, the GMB shut down production almost without any notice. And there had been pending orders, etc., which could not get delivered. So there are some claims for which there is no backing, which we have decided to take we've decided to provision the accounts for that.
So we have actually accounted in this adjustment, including the extra cost or the likely negative results up to March 26, whatever they are going to be having. So that much we already accounted in this by way of impairment. So hopefully we should not have any further provisioning to be made on this account. And as I had said earlier, before the maybe next quarter or so, we will take a decision of the company for the operations there, so that further costs can be cut down, or if we have to take a decision to shut the operations, then we can do that as well.
Okay. Got it. Thank you and wish you all the best.
Thank you very much.
Thank you, sir. The next question is from the line of Anuj Jain from Globe Capital. Please go ahead.
Good evening, sir, and congratulations on the wonderful set of numbers. Almost most of my questions have been answered. Just one question on the export part. Currently, we are having 12% odd for exports, and which was 10% in the last quarter. So going forward, what kind of mix we are comfortable with?
Actually, this is a question of our customers. If we have existing customers who wish to import something from us, we offer a certain price, with which we are comfortable, and if they accept, then we export. So it's not that we actively going out looking for anybody, and we do not discourage them when they come. So this is as it happens.
Okay. And any
7 to 10% export is something what we can consider in a normal course, 7 to 10%.
7 to 10%. And what are the differentiating margins in terms of exports and domestic?
We try to go for the high margin stuff.
Okay. So, I mean,
within exports, there are specialized products everybody cannot make. So we get a better price for that. So when we get that kind of an order, then we accept the order and we make it for them.
Got it, sir. Thank you very much, and wish you all the very best.
Thank you.
Thank you. The next question is from the line of Vikrant Sibil from MoneyCurve. Please go ahead.
Thank you, sir. Sir, since kind of the outlook is so positive on the demand side for us, is there any thought on maybe increasing the capex? Like currently we're doing 600 TPD. Maybe why not go for more capex? And because the commissioning time, the setup time is quite high, right? It takes almost 1.5 years from the date of conception to date of production. So, any plans of kind of increasing capex and kind of going for more capacities?
At the moment, you see, we are sticking to this because it's not a question of money. You need people. This is a very highly skilled operation, and as it is, we are running, we are neck to neck with our requirement for manpower. So we have to train people on this job of actually manufacturing the glass. It's a very demanding, very taxing operation to make glass. So we would rather do what we think we can manage rather than stretching too far and then landing in the soup.
Okay. And would inorganic make sense for you versus greenfield? If that opportunity arises for you in this industry, does that
we can go for a greenfield. We have all the capability to go into a greenfield operation if the opportunity exists or if that is the right thing for us to do. But right now, by growing where we are already located, we are able to have several economies of scale and economies in management, etc., which are very attractive. And so we don't need to, at this moment, consider going outside anywhere.
Okay. Well, that's the thought because, the demand scenario is going to be so strong for next 2 years. If we believe the solar story, I think at some point in time, maybe not now, maybe a couple of quarters down, I think you guys should look to get more aggressive on increasing your capex as well, because the lead time, is considerably high for you to set that capex. So
I agree with you. Well, thank you for the thought. which we accept gratefully, and we'll keep it in head.
Great. Thank you so much, sir. All the very best.
My pleasure. Thank you.
Thank you. The next question is from the line of Ronak Jain from Sangvi Family Office. Please go ahead.
Good evening, sir. I just wanted a clarification that there was a rumor that we are entering into modular rooftop manufacturing. I'm so sorry for humble that. Can you please confirm that rumor?
You see, the point is that as a dynamic company, we have to keep exploring different options. And the option of manufacturing modules comes up from time to time. And we even consider it a little bit seriously. But at this moment, the expansion plans for glass, for the new furnaces for 600 tons per day, are very important, and they are large capex. So they require not just money, but you require manpower, you require management time, and a lot of things. So at the moment, we are not looking at making modules at this time.
Okay. Thank you, sir, for clarification. That's all from my side.
Thank you. Ladies and gentlemen, you may please press star and one to ask questions.
If there are no further questions, we can end this call.
Yes.
Thank you.
Ladies and gentlemen,
thank you.
Yes, sir.
No, you go ahead.
Your closing comments.
No, my closing remarks are just that it's very encouraging to have this kind of conference or a meeting with investors, because many questions are asked, and it makes us happy that people are following this business so closely. We do believe that we are in an industry which is a sunrise industry, and very large scope for growth in this industry. And we hope that all investors will continue to flourish, those who have invested in renewables. So with these remarks, I want to thank you, and I'd like to see you again at the end of the next quarter when we have our next set of investor call.
Thank you, sir. Thank you, members of the management. On behalf of Axis Capital, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.